If you are in a high tax bracket, RRSP is a must. If you are in a low tax bracket, RRSP may or may not make sense. Any contribution that we make is a direct deduction from the gross income. So this person's income will drop from $90,000 to $75,000. If you are a high income earner and your marginal tax rate is very high, then you will get a much larger refund compared to somebody who is in a lower marginal tax rate. The basic idea of RRSP is you contribute in the year where you have high tax rate and you withdraw money from your RRSP when you are in a low tax bracket. So that's how you save the money. Having a large RRSP might be a tax bomb for a lot of Canadians. How does an Registered Retirement Savings Account or RRSP works? Many Canadians have confusion how RRSP works, and a lot of them have very little understanding how the taxation works in an RRSP account. In this video, I'm going to explain what an RRSP account is, some myth about RRSP accounts, how the taxation works, what investment you can invest in RRSP, and some other tips and tricks for spousal plan and group plan. Please stay until the end of the video where I uncover all these details as a certified financial planner. A registered retirement savings plan is a type of account specifically designed for retirement. As you can see, RRSP has some tax advantage where whatever you contribute in an RRSP, the growth of that account is tax deferred, meaning that the money that you make within an RRSP account every year, you don't have to pay any taxes until you withdraw the money. So let's say you contributed $10,000 and that money grow to $12,000 next year, you don't have to pay any taxes immediately for that $2,000 gain. However, when you withdraw that $12,000 in the future, you will have to pay taxes at that time. So it's a tax deferred account, and this account is specifically good for those people who are in a high tax bracket. And I will explain why is that. So before I go to the nitty-gritty of the RRSP plan, I want to clear some of the myth that a lot of Canadians have about RRSP. So a lot of people say that, well, I have to pay back taxes to the government when I'm withdrawing from RRSP. So why am I going to contribute to RRSP? It doesn't just make sense. Well, it does if you understand the tax rate difference. So the RRSP makes more sense for people who are in the higher tax bracket during their work life. And when they are retiring, if they have a lower tax bracket, the RRSP makes more sense. The other myth that I see a lot that the government is going to take care of these Canadians in their retirement. If you understand the government pension, you will realize that this statement can be farther from the truth. Government does have some pension plans such as old age security and guaranteed income supplement, but those benefits are not enough to cover all the expenses that you might have. So relying on the government extensively might be a dangerous thing for your retirement planning. The other mistakes that I see a lot when somebody is in a high tax bracket and they are withdrawing money from their RRSP. As I said before, any withdrawal that you do from your RRSP account, that withdrawal will be added into your income. So let's say your income already is $90,000 and you withdraw $5,000 from your RRSP account. That $5,000 will be added back to your income, which will pushes your income up to $95,000. So if you are already in a high tax bracket, withdrawing money from RRSP does not make sense. Well, sometimes you don't have any choice when you have an emergency. That's a different thing, but normally you should not withdraw money when you are in a high tax bracket. The other mistakes that we see is how people invest within their RRSP. Now, it's a completely separate discussion and it can be very tricky, but normally when you are investing in an RRSP, your RRSP account actually has a lot of tax built into it. So when we design portfolio, we typically put fixed income in an RRSP account. but I see a lot of people invest all kind of stuff in the RRSP. It's an advanced subject, and we will discuss in a separate video in details about tax location. The other mistakes that I see is people misses deadline. So as you know, the RRSP has a specific deadline, which is the first 60 days of the following calendar year. So for example, if you are doing any contribution to your RRSP in 2025, you have the first 60 calendar day to contribute to your RRSP. And every year it's a different date, because if the contribution date falls on a weekend, you typically get a Monday in that case. So check with your CRA website. Typically, it will specify what is the deadline for RRSP contribution. The other mistakes that I see quite often is people contribute to their RRSP when they are in a lower tax bracket. And I'm going to go through a tax table and it will make more sense. So if you are in the lowest tax bracket, RRSP does not make any sense most of the time. So we will go through examples when to contribute to your RRSP. The other mistakes that I see often is people just let it grow too much. RRSP is a tax deferred account, but the withdrawal should be done when the tax rates are low. So I see people never take out money from their RRSP, let their RRSP grow too much, and then they have no other choice to pay a lot of taxes, because at 71, you have to convert your RRSP into a registered retirement income fund, and then you have to pay taxes on those RIF withdrawal. So that's something that you should be talking to your financial advisor, and they will tell you when to withdraw money from your RRSP account. The last mistakes that I see often is people sometimes keep borrowing money, and the banks are typically good at giving these loans, RRSP loans, during the RRSP season, but people keep borrowing from the banks, contribute to their RRSP, but they never pay back the loan amount. Now, typically these loan amounts are linked with prime, and in the last few years, the prime rate has been pretty high, and that makes this kind of RRSP borrowing pretty tricky. So if you are planning to pay off that RRSP loan soon, then I don't have any issue with that. But if you are planning to get this kind of loan and do not pay it off soon, then RRSP loan might not be a great idea. All right, to understand the RRSP taxation, you have to understand the tax bracket, and it will give you much clarity when to contribute to your RRSP and when not to contribute to your RRSP. So this is a tax table from, as you can see, from taxtips.ca, and this is for 2024 tax table. And I want you to focus on the first two columns and ignore the rest of these three columns. So basically, if you see this table, it has the tax brackets for the federal system and the Ontario system. So as you know, that federal government has different tax brackets, and Ontario government has a different tax bracket, and that's why there are so many tax brackets. But if you look at carefully, the first 52,000 almost is taxed at 50%, 20%. So this is a combined tax rate. So both federal and the Ontario government. So this is the first tax bracket. If you are making anything less than that, you probably will pay less than 20%, right? Because you get some tax credit up to amount 15,000 income. So your average tax rate will be less than 20%. Now, as your income goes up, you can see from 51 to 55,000, your tax rate falls under 24%. Now, a lot of people have confusion. They think that as soon as you go to the next tax bracket, your tax rate goes to that rate. Yes, but that's only applicable, this 24% only applicable to this amount. So anything over $51,446 and that will be taxed at this. Anything below 51,000 will still be taxed at this rate. And this concept is called marginal tax rate. So your highest tax rate is called your marginal tax rate, whereas your average tax rate is actually how much you are paying in taxes divided by your total income. So your marginal tax rate will always be the highest tax rate that you pay, but your average tax rate will always be less than your marginal tax rate. So I'll give you an example to the next slide when I go there. But if you look at carefully the tax rate, And I'm talking about every year the government increases this tax bracket to reflect the inflation adjustment. So, for example, if you look at the 2025 year's tax bracket, you will see the numbers are slightly higher, $2,000 or $3,000 more for each of these tax bracket. Because as inflation is positive, everything goes up. Your tax bracket will also be adjusted with inflation. So, if you look at these rates, basically, if somebody has an income of $100,000. I'm just rounding it up so you have a clear number. So let's say somebody income is $100,000. The first 51,000 will be taxed at this. The second, as you can see, 4,000 will be taxed at this. The next 35,000, as you can see, will be taxed at this rate. And then the $100,000 falls between this 90,000 and 102,000. So anything over 90,000 to $100,000 will be taxed at 31.48%. So your marginal tax rate in this example is 31.48%, but your average tax rate will be a blend of all of these rates. So as you can see, your average tax rate will probably be somewhere around 25 to 26%, right? So once your income goes to 100,000, it's not as you're paying taxes at 31%, your highest tax rate is 31%. And that is called the marginal tax rate. Now, you might be thinking, so if you are making a lot of income, like if you are in a high tax bracket, then it makes sense to make more RRSP contribution. So there is no specific point where RRSP makes sense, but as you can see from the tax brackets, once you start going over 111 or maybe 106,000, you are in a very high tax bracket. So your income tax rate goes up pretty fast. Like if you can see here, from 106 to 111, your tax rate went up by 4%. And then from 111,000 to 150,000, it goes almost 6%, right? 6 percentage point. And if you go all the way up to 246,000, then that rate quickly goes up to 53%. So folks who are making over 250,000 or maybe $300,000, RRSP is a mandatory for you because you are paying more than half of your income to taxes. So the higher income you have, the more RRSP makes sense for your situation. So that's the general idea. But if you are in the first tax bracket or maybe even the second or third, RRSP does not make that much sense for you. Well, there are some cases where RRSP makes sense, even if you are in a low tax bracket. If you are getting some Canada Child benefit, depends on how much your family income. So if you are above $80,000 family income, then maybe sometimes a few $1,000 RRSP contribution will get you some more Canada Child benefit. But in general, if you are in a high tax bracket, RRSP is a must. If you are in a low tax bracket, RRSP may or may not make sense. What do you do if you are in a lower tax bracket? In those cases, we tell you to contribute to your tax-free savings account first, or TFSA first. Or if you are eligible for first home savings account, then FHSA account might be better alternative before you contribute to your RRSP account. All right, so let's take a look at an example how the tax system works. So in this example, you can see the gross income for somebody is $90,000. So that person falls under the third tax bracket. And at that third tax bracket, that person's marginal tax rate is 29.65. Now, if you add all of these taxes, this person is going to pay $21,600 in taxes. This case, the top example is without any RRSP contribution. Now, what happens if we make a $15,000 contribution for that person? So as you know, any contribution that we make is a direct deduction from the gross income. So this person's income will drop from $90,000 to $75,000. So that person's taxable income will be $75,000. Now, here is the tax implication of that $15,000 contribution. Now, you can see the first tax bracket's tax is still the same. It doesn't change anything because what is getting affected is this third tax bracket. So this person's income is dropping from 90,000 to this $75,000 range. And this person is paying lower tax in this tax bracket. And this is how much he's or she is paying in total tax. So you can see there's almost a $4,000 difference here, which is if you multiply this 15,000 by this marginal tax rate, this is exactly how much your tax savings is. And I'm going to explain in the next slide how that refund works. So basically, you are bringing your taxable income down from $90,000 to $75,000 when you are making a $15,000 RRSP contribution. And the math is exactly the same for first home savings account. So if you are contributing to a first home savings account, the math is exactly the same because your income is going down by the amount you are contributing to the FH account, first home savings account. All right, so this is an example of our refund calculator for a different person who is making $150,000. So this is a calculator from Ernst & Young. So as you can see, somebody making $150,000 taxable income, that person in Ontario is going to pay $42,000 in taxes. So that's that person's total tax bill. And that after-tax income will be around $107,000. The marginal tax rate, as we already know, is the highest tax rate for $150,000, which is 43.41%. And the average tax rate, remember, we are averaging the tax. So basically, we are taking this total tax and we are dividing that by taxable income. That is your average tax rate, which is lower than your marginal tax rate. So in this example, you can see that you are in a very high tax rate, and any money that you can save will save you on the marginal tax rate. Now let's take a look at what happens if we make a $20,000 RRSP contribution. So your total contribution is $20,000. So your taxable income will drop from $150,000 to $130,000, and you will receive a refund for that $20,000 contribution. How much is the refund? Your refund is in Ontario is $8,682, which is exactly the same if you take your marginal tax rate and multiply that with the RRSP contribution amount. This is the same amount as 8682. So what does it mean? So this means whatever contribution you make into your RRSP account, you will get a refund based on your marginal tax rate. So if you are a high income earner and your marginal tax rate is very high, then you will get a much larger refund compared to somebody who is in a lower marginal tax rate. And that's the example we are doing in the next slide. So we are doing the same $20,000 contribution for somebody who is making $50,000. So somebody who is making $50,000, as you can see, they are paying very little tax. They are paying only $7,000 tax. And their marginal tax rate is only 20%, and their average tax rate is only 14%. So if I do the same $20,000 RRSP contribution, that person is only getting a refund of $4,000. Remember, because we looked at their marginal tax rate, which is around 20%. So 20% times 20,000 is $4,000. So as you can see from two of this example, for high income earner who is in a higher marginal tax rate, RRSP makes more sense. For somebody who is in a low tax bracket, RRSP usually does not make that much sense. So to wrap this up, the basic idea of RRSP is you contribute in the year where you have high tax rate, and you withdraw money from your RRSP when you are in a low tax bracket. So that's how you save the money. So basically, let's say the years when you contribute, your tax rate was 40% on average, marginal tax rate, and the years you withdraw from that RRSP, usually it's in the retirement. In the retirement, you don't have any other income. So in the years where your income is low, you're probably paying at 25% tax rate. So you save this difference from 40% to 25%. You save that 15% tax savings, and that is basically what you are saving in your RRSP. So that is exactly the example here. So in this example, Rahul is making 150,000 in the years he made contribution, and in the retirement, his income is 70,000. So his marginal tax rate is much lower but when he was contributing, his marginal tax rate was higher. So this 48% minus 30%, that is the tax savings, and that's the benefit of contributing to your RRSP. If you are already in a lower tax bracket and your tax rate will be higher in the future, RRSP does not make any sense for you. TFSA is a much better solution for you. So to wrap up, so how much can you contribute to your RRSP? So to find out this information, you have to look at your notice of assessment. But in general, whatever your income last year, 18% of that income up to a maximum of 32,000. And this number also changes every year because it goes up a little bit every year. But 18% of your last year's earned income, that is how much you can contribute to your RRSP account. Now, where do you find that information? You go to your notice of assessment. So notice of assessment is a document that CRA gives you once you file your tax return. So you probably have your 2020 tax return 3 tax notice of assessment already. So if you pull it up, you will see something like this. And you go to the second page of the notice of assessment. This is where your RRSP information is listed. So basically, you can see here somebody may had an RRSP contribution room of $156,000 from previous year. They made some money, and this is the bottom line. You can see this is how much this person can contribute to their RRSP. So whenever you are contributing to your RRSP account, make sure you're always checking your notice of assessment. You can also find this information from your CRA online portal. So when you log on to your CRA online portal, if you go down to the bottom, you will see there is 2 contribution room listed. One is RRSP contribution room and one is TFSA contribution room. So you should always double check before you make any contribution. So I already explained you the RRSP contribution deadline before. Basically, it's the first 60 days of the following year. So I'm recording this video early 2025. So this year we have March 3rd, 2020. So any contribution that you make before that deadline, you can still use that contribution for the tax year of 2024. So you can still make a contribution in February or in January, and you can claim that contribution on your 2024 tax year RRSP contribution. So talk to your financial advisor and make sure you don't miss the deadline. Now, what can you do with your RRSP money? It's a different types of discussion, but I just want to quickly give you an idea. Basically, most of the time people contribute to your RRSP because they want to save for retirement. As you already have seen how the tax advantage works for you. So you can save money for retirement. Again, any growth during that time is tax free. Like you don't pay any taxes every year. You only pay taxes when you withdraw. So any growth over the time is tax deferred. So that's an excellent way to invest. Also, if you qualify for first home buyer program, then you can withdraw up to $60,000 from your RRSP for the down payment. And if you are planning to go to university or college, and if you want to study, then you can also withdraw this RRSP money for lifelong learning purpose. If you qualify for any of these, talk to your financial advisor to learn more. Now, what happens when you withdraw money from your RRSP account? So any withdrawal you make from your RRSP, there is a tax implication. Unless you qualify for those homebuyer plan or lifelong learning plan, other than those 2 options, if you withdraw any money from your RRSP, you have to pay taxes upfront. What does it mean? So let's say you withdraw $5,000 from your RRSP account. The bank will withhold $500 and send it to CRA and only give you $4,500. So that is called withholding tax, meaning that you are prepaying the taxes for that $5,000. And if you withdraw anything between $5,000 to $15,000, then you will be paying withholding tax 20%. So let's say you withdraw $10,000, you will be sending CRA $2,000 upfront and only receive $8,000 from your RRSP. Anything over $15,000, you will be paying 30% upfront, and then when you file your tax return, that's the time when your final tax amount will be adjusted. So let's say you withdraw $20,000 from your RRSP, and that's the only income you had. There is no other income. So what will happen is you will be paying $6,000 to CRA upfront, but when you file your tax return, they will recalculate your amount, and they will figure out, okay, there is no other income, so you should be paying only, let's say, 20% for the $5,000. So let's say you are supposed to pay only $1,000 tax, but you already prepaid $6,000 there. From that withholding tax, the government will give you $5,000 refund. Now, if you have to pay more to CRA, let's say you paid some money in withholding taxes, but those are not enough because you are in a very high tax bracket, then you may have to pay more when you file your tax return. So any withholding that you are doing when you are withdrawing the RRSP will be adjusted when you finally file your tax return the following year. So it's a little bit tricky, but your accountant will tell you exactly how much tax you should be paying to CRA. Or if you do your tax return by yourself, then your software will also calculate that for you because they will get a receipt from your bank and it will specify how much you already paid to CRA for this withholding tax. Now, one of the most common missed opportunity that I see among Canadians is the uses of spousal RRSP. So, spousal RRSP is a concept where you are somebody who is in the high tax bracket and somebody who has a spouse who does not have high income tax. The spousal RRSP makes a lot of sense. I give you an example. Let's say you are a lawyer and making $250,000 a year, and you have a stay home spouse who does not work. So your spouse does not have any income, but you have $250,000 employment income. So as we already know, you are in the top marginal tax bracket and you will be paying a lot more taxes. Now, in that case, spousal RRSP makes a lot of sense. So any contribution to spousal RRSP, the higher income spouse gets a deduction. So in our example, the lawyer will get a deduction. So let's say we contribute $30,000 to spousal RRSP. The lawyer's income will drop from $250,000 to $220,000. And this $30,000 will go to the lower income spouse's RRSP. Now, most bank will open up a spousal RRSP account for the lower income spouse, and the lower income spouse will take that $30,000 and contribute. Now, this lower income spouse will invest that money, grow that money, and when that person withdraws money from that spousal RSP, they will probably pay at a much lower tax bracket because that person is a stay at home person. That person does not have any other income. So they will pay at a much lower tax bracket compared to if the lawyer had contributed to the lawyer's RSP and withdraw at a later date because the lawyer might have other pension income or maybe CPP income, or maybe that lawyer wants to take early retirement. Normally, if you are below 65, there are only few things you can income split between spouses, but somebody who is planning to retire, let's say early 50s, having a spousal RSP makes a lot more sense when you are building funds for your lower income spouse. The bigger the difference between the higher income spouse's income and the lower income spouse's income, the more the spousal RSP makes sense. So talk to your financial advisor to explore if your scenario falls good with the spousal RSP scenario. So as I said, spousal RSP is a wonderful tools for a couple who have significant income difference, but spousal RSP comes with some restriction. So there is something called an attribution rule, 3-year attribution rule, meaning that if you contribute to your spouse's spousal RSP, if you withdraw any money within 3 calendar years, that withdrawal will be attributed back to the higher income spouses. So in our example, if the makes a spousal RSP contribution and a couple of years later, the lower income spouse withdraw that money from the spousal RSP, that withdrawal will attribute back to the higher income spouse's income, and we might not get the benefit of contributing to the spousal RSP. However, if the withdrawal is taken after 3 calendar years, then the withdrawal amount will be taxed at the lower income spouse's tax rate. So always make sure that you are withdrawing after the 3-year period to avoid these attribution rules. The other strategies that you should look into during the RRSP season, so to take a spousal RRSP loan. A lot of people don't have cash to contribute to RRSP accounts, and the banks typically gives you quick RRSP loans during the RRSP season, and basically it's a loan from the banks at a low rate, usually at prime. Basically, you take out the money from the banks and make a RRSP contribution, and when you get the refund from your tax return, you take that money, pay back the loan. You might have a little bit of loan left because the refund you'll be getting will not be enough to cover the full RRSP loan amount. But the idea is once you get the refund, you pay back half the loan, and then in 5 to 6 months or maybe a year, you pay back the other outstanding balance. If you are doing that way, I'm okay with that, because if you are in a high tax bracket and don't have any money to contribute, then RRSP loan is not a bad idea. But again, as I said in the beginning, please do not rely too much on the RRSP loan, because it may get you into the debt spiral, and you may not ever come out of the loans. And with high prime rate like 2023, 2024, we will be paying a lot more in interest. But again, if you are in a high tax bracket and you don't have any other resources to contribute to your RSP, look into the RSP loan strategy. The other concept that you should be aware of is over contribution. So any time you are making a RSP contribution, make sure you stay within the limit. As I explained in the previous slide, you should be looking at your RSP contribution room. If you over contribute, then there is a 1% penalty for any excess amount. So let's say your contribution room is $15,000, but you contributed $25,000. There is a 1% penalty for that excess amount. So usually the government gives you a $2,000 room, but in this example, there will be a 1% penalty for the $8,000 excess contribution. So until you withdraw the money, the government will keep penalize you with the over contribution penalty. So what can you invest in an RSP? Pretty much everything. So you can buy stocks, bonds, ETF, mutual fund, GIC, savings product. So basically you can buy anything you want in an RSP. You can also buy call option, put options. So if you are into that kind of things, but basically you can buy any qualified investment that CRA has allowed. Sometimes people can also buy RRSP mortgage. It's not pretty common in Canada, but there you can also, in general, our approach is to keep the fixed income portion in the RRSP account for majority of the retiree people. Another important factor, if you are opening up an RRSP account, make sure you are adding your spouse or a beneficiary on that account, so that if something happens to you, the money is transferred to your beneficiary in a tax efficient. The money is transferred to your beneficiary in a timely manner. And if you have a beneficiary listed on your RRSP account, that account is not part of your estate. So talk to your financial advisor for implication, because sometimes going through the estate is also a good option. So your advisor will tell you when they are doing the estate planning, they will tell you whether to add your spouse as a beneficiary or let the RRSP go through the estate. So talk to your financial advisor for the estate planning discussion. But if you are just starting out, please make sure that you are adding a beneficiary on the account. And the last topic is basically what happens to your RRSP. So when somebody passes away, if there is a spouse, typically the RRSP can be rolled over to the surviving spouse without triggering any taxes. So let's say I have a RRSP account of $500,000. I pass away. That $500,000 will roll over to my spouse on a tax-free basis. So there is no tax implication for this rollover. But when my spouses pass away, that's when the CRA comes in and asks for their money. So basically, the surviving spouse, before it goes to the beneficiary, that's when that CRA has to be paid, and the estate has to pay the taxes for those RRSP amount. So any balance that RRSP has needs to be added to the deceased income tax, uh, and and all the amount is fully taxable, and the estate has to pay taxes before it can be distributed among the beneficiary. So this is one of the reasons why having a large RRSP might be a tax bomb for a lot of Canadians. And I explained this concept in a separate video. So if you want to understand how a big RRSP becomes a tax bomb for a lot of Canadians, please check out this video.